What is the risk premium and its components in finance? Imagine investing your hard-earned money and wondering how much extra you might earn for taking on additional uncertainty. That extra compensation is known as the risk premium. It plays a crucial role in financial markets by incentivizing investors to accept the possibility of losing part of their investment in exchange for potential higher returns. Understanding what constitutes this premium and its different parts can help investors make more informed decisions. The risk premium is essentially the additional return an investor expects to receive above a risk-free rate for holding a risky asset. The risk-free rate is typically represented by the yield on government securities considered free of default risk, such as treasury bonds issued by stable governments. The difference between the expected return on a risky asset and this risk-free rate is the risk premium. It compensates investors for bearing various types of risks associated with the investment. One of the primary components of the risk premium is the equity risk premium. This is the extra return investors demand for holding stocks over risk-free securities. Stocks are generally more volatile and susceptible to economic fluctuations, so investors requiring a higher compensation for the increased uncertainty. The equity risk premium can fluctuate over time based on economic conditions, investor sentiment, and market volatility. Another significant component is the credit risk premium. This applies mainly to bonds and reflects the additional yield investors seek to compensate for the possibility that the issuer might default on its debt obligations. The higher the perceived credit risk of an issuer, the larger the credit risk premium demanded by investors. Credit rating agencies assess the creditworthiness of issuers, and these ratings influence the size of the premium. Market risk premium is also a key element. It accounts for the overall risk associated with the entire market or economy. This premium is influenced by macroeconomic factors such as inflation rates, interest rates, and geopolitical stability. When market volatility increases, so does the market risk premium, as investors seek greater compensation for the heightened uncertainty. Liquidity risk premium is another component, representing the extra return investors requiring for assets that are difficult to buy or sell quickly without affecting their price. Assets with low liquidity tend to have higher risk premiums because investors face the possibility of not being able to sell their holdings at a fair price when needed. In summary, the risk premium in finance is the additional return investors expect for taking on various types of risks. Its main components include the equity risk premium, credit risk premium, market risk premium, and liquidity risk premium. Each component reflects different sources of uncertainty and helps explain the overall compensation investors seek in the financial markets. Recognizing these components can lead to better investment strategies and a clearer understanding of market dynamics.